Hi everyone, I am Nilesh. I am part of Avendus Structured Credit platform. While we have seen a lot of action happening in the Indian private credit industry over the last 12 months, however, I just thought it is important to have some of the outside in or a global view also. So over the last 2 to 3 months, I have been meeting a lot of global LPs as well as attending some of these conferences. So just wanted to share some of the key takeaways in terms of where the global private credit industry is, where does India fit in, how fundamentally we will have to look at private credit, I mean when it kind of evolves from where it is today to whatever level it has been there globally, and in particularly what are we seeing in India, what are the growth drivers as well as what are the things that needs to be set in right for Indian private credit industry to grow. I will categorize it into 3 broad points. The first point is where the global private credit industry is, what do they expect, what are the returns, and where does India fit into. Globally, the size of the private credit industry is estimated to be somewhere around $1.2 trillion, out of which $700 to $800 billion is in US, $400 billion is in Europe, and that kind of leaves around $100 billion for rest of the world. And that's why how the investors of this developed market think about the yield becomes very, very important. As of today, because of the US interest rate rising, inflation, and more importantly, the currency depreciation which has been happening, the yield expectation from some of these global investors, which has been ranging, let's say, between 8 to 12% dollar yield in the private credit industry, means that an emerging market or a country like India will have to develop a yield of around 16, 17, 18% to kind of meet this kind of a requirement, basis the withholding tax as well as the hedging cost that goes into it. And that kind of, as of now, makes it a bit more difficult for large capital inflows to happen from a developed market to the emerging markets. Second most important takeaway was that global private credit investors are looking at this as an investment strategy, like private equity investment, right? What it means is that the fund should be able to increase the allocation or investment if it is required, as well as have the flexibility to change the cash flow payouts based on the changing business needs. And therefore, it is also required that a fund is able to do multiple products within the same strategy to be able to generate the desired return over the entire fund life cycle, given that the cycles are shorter and more volatile. For example, doing pure structured debt throughout the fund life cycle may not work. You may need to look at convertibles, hybrid, or a structured equity also as a part of the overall structured credit strategy. The third takeaway was that India as a country is quite favorably poised right now, given the situation in the other emerging market or the geopolitical developments which are happening. While we have seen over the last 12 months, Indian private credit industry has grown a lot because of some of the investment moving from banks to private credit as an asset class evolving, or some of the transactions which were earlier done by equity investors also coming to the private credit. However, it is currently being dominated by the domestic pool of capital. So in order to attract large pools of foreign capital, our legal and regulatory systems also will have to evolve in order to give them comfort on the realizable value of their investments. Look forward to sharing more experiences with you in the future.